If I said the 10-year yield was going to get to a 15-year high,
right,
what would you say stocks would do?
I would say the S&P 500 is 3,800 on its way to the October low, that equities are not trading well, that Russell small cap stocks are probably underperforming the broader market, which is getting whacked. And the VIX is probably approaching 20.
And what happened today?
None of those things are happening, which is really interesting. So how does it reconcile yourself with? Is the second part of the answer. Well, it's one of two ways, obviously. Yields start to back up and equities continue to go higher, or yields continue to go higher and equities figure it out. By the way, I think there's a scenario where yields go lower and equities go lower, because if the equity market leads and starts to sell off precipitously, you might see a flight to quality in the form of the bond market, Melissa Lee.
Well, and that's what's interesting about where rates are, because if you had told me, you mentioned SVB, if you told me that rates are back up to where they were pre-SVB, I'd say banks probably have been rallying. And for the most part, banks have been the biggest underperformer of the major sector groups. Look, I love Marco's work. And in fact, when he says stuff like this, I listen. Pointing out divergences in this market is easy. And we've been doing it. Marco's been doing it. A lot of people have been doing it, which whether it's the, leading indicators versus a forward P of the S&P. I mean, talk about a divergence. I mean, there's all kinds of things going on. But clearly, as it relates to today, and this is a big week. This is a week where we have policy decisions in the U.S., in Japan, in the BOE. And, it was a day when actually Japanese stocks went to a 33-year high on the topics. But it was a day when equities this morning, we looked at the screens in the first hour of trading, even the first half an hour, semis, which are the leadership group, were down big. So the correlation, equities, I think, have been trading in sympathy with bond yields for the last month. There's a big disconnect to close at some point on valuations, but I think the stock market for the last month and a half has been paying attention.
Yeah, I'm glad you brought up small caps. I mean, the underperformance there, I think, is interesting. And we also know, again, there's a whole host of financially oriented sort of names. If you look at the KRE, the regional bank index, does not act particularly well. Looks like it's breaking down technically. And, I think, again, I think what Tim says, it's been very easy to point out divergences. It hasn't been easy to make money on those divergences. And right now, when you think about where yields, where they are relative to where they were a year ago and where the S&P is, it's really astounding. We're basically 4,600 versus 3,600. If you look at crude oil, was also last at these kind of levels, about 9-10 months or so ago. And then when you look at the dollar, the U.S. dollar, the way that's moving, all that to me should not be supportive of equity valuations. It's taking note, I think, within small caps and financials, like I just said, but it's yet to do that in the broad market. And I'll just make one last point. In late 2021, there were no shortage of signs that we were about to go into an equity bear market, despite the fact the S&P made a new high in January of 2022. There were lots of things under the hood. That was a big narrative that we talked about on the show. I think similar things are playing out right now in the equity markets. And if you're just looking at other risk assets away from equity markets, it should signal, at least it does to me, that we could be in for a period of downward volatility in the not so distant future.
Are you worried about stocks, Grasso?
Yeah, I'm always worried about stocks. But, for your Marco, I'll raise you a Mike Goldstein at Empirical Research, where he points out that interest rate sensitivity for the U.S. economy is really less dependent on those where it used to be more dependent. I'm paraphrasing, obviously. He's, the path of interest rates doesn't dictate the market, as you all have just said. When you look at the market now, look at last week. I think the most important things that happened last week were the UAW, it was Apple, it was China, it was spilling out to the rest of tech, it was oil moving higher. I don't think necessarily, and then throw in there CPI and PPI. You had some positive news there that made the market react with higher interest rates, which doesn't necessarily mean that the market's going down. And then if you look at FactSet, the analytics through them, this week in September is historically the worst week, or 5 straight losing days in the market for the last 73 years. That's pretty important because you have mutual funds that wrap up their fiscal year in September and in October. What does that mean? They mark up and they mark down. But October is historically the month that everything rallies back because we're going into fourth quarter. People are looking towards November and December and that seasonality. So I think this September has the outsized propensity to suck in a lot of bears. I'm not as worried as I think I should be on the market.